So I thought it'd be a fun little experiment if we looked at some of the companies that were trading at the same basic multiple that the S&P 500 as a whole is trading at in terms of price to earnings. Right now, the S&P 500 is trading at around 25 times price to earnings. And so that would equate to, if you were to reverse engineer it, a 4% earnings yield. And so in your share terms, if you pay $1,000 for the S&P 500, it's going to pay you about $40 per year of current net income. That's what that is. And so I'm going to put it in. Here is the lower range of the net income per $1,000 invested in that. Takes our universe of 5,500 down to 1947, but we're going to make it even narrower. We're going to say 40 to 4050. So basically, companies that are trading at almost exactly a 25 times price earnings. This brings us down to 22 companies. 22 companies are trading basically on parity with the S&P 500. So one way you could look at this is you could say either I could put $1,000 into, or $1 or $1 million, whatever your number is, into the S&P 500 today, or I could buy one or more of these companies. Which is more attractive? Setting aside diversification risks and all that, let's just dive in, okay? So what I'm going to do is I'm going to pick, this screening results shows I could screen by lots of other factors: debt, growth, cash, dividends, payout ratio, cash flow, free cash flow, all these things. I could share counts, or growth in shares. This one here, that's my favorite of mine. But we're going to disregard all that today, and we're just going to evaluate 5 companies to see if any of those 5 might potentially be more attractive than the S&P 500 itself. So let's start by looking at Centerpoint. That's CNP. It's trading at 40.29, which is, again, that's basically an earnings yield of 4%. If you reverse engineer that, the inverse, you're getting a 25 times price to earnings. Let's look at Home Depot. Let's look at Meta. Let's look at Taiwan Semiconductor, and let's look at TriNet. So I'm going to compare selected, and here we go. We're going to look at these companies on a number of different dimensions. We're going to try to weed them out to see what is left standing at the end of the day, and then whether or not that might be more attractive than the S&P 500, or at least part of our money, not all of it, but part of it going into this. Okay, not investment advice. So this first chart shows you the net income. If you're putting $1,000 up, that these things have earned, that your $1,000 today would have earned historically for you. Each of the different colors. You got Centerpoint, Home Depot, Meta, Taiwan Semi, and then TriNet. What you can see very quickly is that Centerpoint's earnings are what I'd call highly volatile. They're way up, they're way down. They're sort of flat here, but this is a utility. Centerpoint is a utility. It's in the Houston kind of area. It's supposed to be flat, you would think. It's a utility after all. But no, it loses $40 for your $1,000 investment one year. It makes $110 another year. And then it's down. It's down to $21. And it's up and it's down. It's up and it's down. This is not my kind of company. You can also see over the last 10 years, we could have looked at the last chart on the last page, but there is no positive growth. This probably means that that they lost money, so you couldn't calculate a 10%, or sorry, a 10-year CAGR. Have not only growth in net income, but some very substantial. You've got 11.8% for Home Depot, 39% for Meta. That's unbelievable. Taiwan Semi, almost 18%, and TriNet, about 25%. These are all much healthier in terms of growth. And if you look at just the chart, they're all sort of up and to the right, which is not so clear right now because this craziness, this volatility of Centerpoint is skewing things. So let's get rid of Centerpoint. Let's look and see what it looks like now. It's going to reload. Okay, now we get a much clearer point. So we see different starting points, and this drastically changes the end point. But we see they all end up just about the right place. TTM is trailing 12 months, which means the end of their most recently completed quarter, and then 4 quarters back from that point. We can also see that, let's just look right now, TriNet was really growing, and then it fell off a cliff from 2023 to 2024 and into the trailing 12 months. What happened? Well, let's look. We already looked at their growth. They're growing 25% a year on average over the last 10 years. That's really fast. So what happened? Well, it could have been the revenue went down, but here we go. I think what happened is their margin went way down. You see their margin, their operating margin, meaning the amount that they made in pre-tax profit, or maybe it's post-tax profit. I can't even remember now. I think it's post-tax profit. In 2023, they kept 0.8 cents of every dollar that they sold in sales. But in 2024, that went down, that cut in half to 5.69. They're barely like a just very thin margin kind of company. Like, look, they're at 5.8% right now. Whereas Taiwan Semi and Facebook, or Meta, they keep almost half of the dollars that they make in revenue, they keep as profit. These are signs of moats. These are, like they say here, pricing power. And Warren Buffett talks about uh, margin being a real good sign of moat. Then you've got Home Depot, which is very steady, but again, a smaller margin. And it does appear to have been losing ground a little bit. 13.5, 13.5, 14.2, 15.2. So you can see it's a little bit of a downtrend. And that might sound like small dollars, 15 to 14 to 13. But when you're talking on a percentage basis, those are substantial decreases in profit for every dollar that they make in sales, which they can only make up by making more sales in the aggregate each year. So right now we can see that TriNet is probably, to me, the least attractive because it's operating on razor thin margins and it's had drastic decrease in profitability. Before we knock it all off of this, let's look at what it looks like for its revenue, okay? Dividends, Home Depot's chart is just beautiful. This $1,000 would have, the same number of shares would have been paying you $6 back in 2015. And now it's paying you $24, which is a 2.425% yield on your $1,000 that you put in. That's pretty good, all things considered in current society. Taiwan Semi, you can see it's paying about a 1%, 1.2% yield, and TriNet is paying about the same, whereas Facebook is on here, it's paying you like a 0.3% yield on your money, but no big deal. They are plowing the money back in and making enormous amounts, so it is a good idea. So we can look at their payout ratio. Just looking quickly at this left axis, nobody's paying out more than 100% of their net income, which means this is probably all sustainable for a long period of time, at least so it seems. I mean, even the highest one is Home Depot at 60%, which means out of every dollar of post-tax profit they make, they're keeping 40 cents of it and plowing it back into the company or into buybacks or both. Now let's look at revenue. Okay, so we've got TriNet is still growing its revenue nicely. And it looks like these other three are flat, right? Like this is a pretty flat line. This is a pretty flat line as well. And you might say, well, gee, TriNet is the one that's growing fastest. But let's look on a percentage basis because, again, you're starting down here with almost no revenue, $10 in Facebook up to 102. So it's grown 10x. That's a 10x growth. You can't tell because of the scale of this chart. But this chart down here really does show you. Home Depot, about 10% a year. Hey, great. Not knocking that at all. Meta, almost 30% of your revenue growth. And remember, they keep about half of that in profit. That's unbelievable. Taiwan Semi, obviously, with all the stuff that's going on with AI, they're at 16%. And then TriNet, you got 12% revenue growth. Here's what I'm going to say at this point in time. I'm going to say, let's look at debt, but we may want to get rid of TriNet. So if we look at TriNet right now, we can see that they have, for every $1,000 you put in, they have $218 of long-term debt. Let's see how much cash they have to see if that balances out. So we go down here, they have $83 of cash, and they have $218 of debt, long-term debt on their balance sheet. So net that out, say they've got, round numbers, they've got $150 of long-term debt net of cash. What does that mean? That means imagine if you're buying into your friend's car wash, you're buying a minority interest, you're buying 10% of your friend's car wash. He says, oh, great. You gave me that $1,000. I tell you what, that lets me borrow another $150. I'm going to go to the bank and I'm going to borrow another $150. That's effectively what this means. So TriNet is doing that. Whereas Facebook, when you give them that dollar or that $1,000, they have $17 of long-term debt that they take on, but they also have $17 of cash, which means they don't take on any debt at all. It is a wash. So if you give $1,000 to Facebook to put into their business effectively, think about it like that, they're not borrowing anything on top of that, but TriNet is. I don't feel comfortable with that. Home Depot is as well. It's clear, but they're borrowing less. $131 of long-term debt. And let's see what they've got in cash. Not a lot of cash, $4. So they're basically borrowing nearly as much as TriNet, but they are also a lot sturdier company. They're not a software company. They're a hard goods company. They have stores. They have inventory. They have, shelves. And so I'm going to, at this point, say TriNet's out. So let's click on TriNet, and you did not make the cut. Goodbye. Okay, so now TriNet's out. Let's see how these charts reboot, and let's look at them again. We've got for net income, what I want to see is I want to see up and to the right. And what I see is that they're all sort of up and to the right, except let's look at Home Depot for a second. Home Depot is not up and to the right for all of the years. Starting in 2022, that was their peak of $45. Your $1,000 would have bought in 2022, these same shares would have earned $45. And then in 2023, $41. And in 2024, $40. Do you remember what we talked about earlier? We talked about this margin going down. Doesn't look like a lot, but remember, it was 15% here. It's 13.5% there. I don't know what that's a 10% decline in the amount of money that they make on every dollar they earn. So in other words, if sales had stayed flat over these years, from 22, 23, and 24, they would be making 10% less profit in this year just because they're keeping less of every dollar. Now, obviously, they're not making 10% less, or are they? Let's see, 45 to 40. They are making 10% less, which means that I'm going to predict that their revenue has basically stayed flat over this period of time too. Let's go down and look. So we've got revenue. Here it is. Well, what do you know? It's flat. $414, $410, $433. This is a very flat line at the top. It went from growing quickly to flatlining. This is, to me, not attractive business to buy, especially on the base relative to Meta and to Taiwan Semi. It may be still compared to the S&P 500 because they may have greater growth prospects, but there can only be one in this game. And so let's look again at what their debt is. So their debt is, when you give Home Depot $1,000, they're going to borrow $130 basically. They have only like $5 of cash right now. So they're buying, $125, let's say. $125 they're borrowing every time you give them for every $1,000 of equity that is in there, or market cap that's in there. To me, that's not a bad thing, but we're trying to look for the best. I don't think this is the best. But let's look at one other thing. That's buybacks. So what we can see is that Home Depot is buying back about 2.8% of its stock every year, compounded annually over time. That's the average of the last 10 years. Meta, on the other hand, is only buying back 1%, and Taiwan Semi is not buying any back at all. So how should we interpret this? Well, we should interpret this really as a negative sign for Home Depot relative to Meta. Why is that? Well, they both have lots of free cash flow. That's what we're talking about right here, okay? Free cash flow is basically after CapEx, it's what's left over. You can pay out dividends, you can reinvest in the company, even more for growth beyond just maintenance, or you can buy back stock. But the two big things you do with free cash flow, you buy back stock or you pay out dividends. You could also let the cash accrue on the balance sheet, but nobody wants that. So, and again, they're all trading at basically the exact same price to earnings ratio, like within tenths of a percent, or just a couple of percent of one another. And so what this is really saying is, remember, how are each of these companies using this cash flow? Well, we see the payout ratio. We see that of their annual profits, Facebook's barely paying out any in dividends. But look here, we see that Home Depot is paying out 60% of its profits in dividends every single year. And then on top of that, they are also using a whole bunch of that money to buy back stock every year. And so what does that mean? Well, that means that they don't have any more attractive investment opportunities for growth than to give you money back and buy back shares to increase your ownership. Not the worst thing in the world, don't get me wrong, but this is a sign of a mature company without very much in the way of growth prospects. Meta, on the other hand, it's buying back a little bit of stock, but you know what it's doing with all that cash? It's reinvesting it in the business. And do you know why? Its net income has grown by almost 40% compounded annually for each of the last 10 years because they have massively profitable things they can invest it in. I mean, imagine if you take that and you are able to make a margin of basically half of every dollar that you sell, you get to keep. It's a cash flow machine and a cash machine. Now let's also look at the operating margin going down for Meta over 2 years and then popping right back up again to the long-term level. And let's look at the net income going down for a year. What that was is, you remember the metaverse and the reason why it's called Meta? That's when Zuckerberg kind of went off on a tangent and started spending a ton of money on what he thought would be the big deal. It turns out it's not. It's AI. It should have been AI. And they've now redirected. But in light of that, we now need to eliminate the Home Depot. Okay, we are now in a race between Meta and Taiwan Semi. And I'll be honest with you, I think these are both pretty good companies to buy relative to the S&P 500 from a valuation perspective. If you're going to pay the same for $1 of earnings from the S&P or for these, and assuming you're otherwise diversified, I would go with one of these. My own personal favorite is Meta because it is very light in terms of assets, whereas Taiwan Semi has lots and lots of assets they have to have, foundries and otherwise. They have lots of capex. And two, there's political risk with Taiwan Semi, with China and everything else, that Meta just doesn't have. Three, you can look at the historical trend, and this really tells the difference. Like, though Taiwan Semi started in 2015 earning $9 to the $2 of Meta, Meta has caught up with it entirely. So Meta started out 4.5 times lower than Taiwan Semi, and it's already caught up. I think that trend is going to continue. That is why, if I were picking between all these companies, I would pick Meta. So let me ignore that. Now let's go and look at Meta in more detail. So I'm going to go to the Evaluate tab, and I'm going to type in Meta. Let's pull it up, and let's look in more detail. So if I spend $1,000, here's what I get in revenue. 102 revenue, $40 in profit, all these things. But here's a cool little feature. If I say I'm not going to spend $1,000, I want to spend 25,000 or whatever the heck the number is, and then let's click enter. It's not $102 anymore you have, it's $2,563. You can literally see what $2,500, $25,000, $25 million buys you in Meta because you're buying a share of the business. This is really a new business segment in your startup company portfolio, your stock market startup, as I say. So we can look at net income. It's just a thing of beauty except for the black eye of the metaverse for this little bit of time, but then it's continued its trend. We can look at operating margin, which again took a giant hit when Zuck did his whole metaverse thing, but now they've reversed that, and it's a beautiful thing. They're keeping such a high percentage of their dollars. You can see what historically the price to earnings was on Meta. I mean, it's always been a tremendous bargain in my view. But even today, this is as of 2 days ago, is 24.93, so a little bit less than the market. It's trading at a discount to the market despite its very fast growth. Look at the revenue. This is a straight up hockey stick here. 26.4 CAGR over the last 10 years. That's just amazing. You can look at long-term debt. You can look at cash. These are, again, based on a $25,000 investment, which is why it says $400. That effectively means that they're going to, when you pay $25,000, your share of the cash on the balance sheet is $432, and your share of the long-term debt is $433. It nets out, and so it's basically zero. You could look at cash flow from operations, another hockey stick. Free cash flow, you could look at the payout ratio. It's minuscule. This looks like a hockey stick up, but it's because it's at 7%. Like it's just, this is the y-axis scale. Let's say we want to buy it, and we want to memorialize our thoughts and go back and look at it. So I'm going to click Create Memo. So let's create a memo, shall we? So we've got Meta, and we said we're going to invest $25,000, right? Okay, and we're going to do it now. We can change the title list later. We could talk about why we're going to do this. I like to do the investment thesis at the end, not at the beginning. So we'd look at, this takes us step by step through. We can see like, okay, so Meta's profitability is growing at an impressive rate, whatever you want to say, and you could capture your thoughts here. And then you can try to, track whether Meta is going to stay on your goal. So it's currently making $1,000 for me. I think next year it's going to make $1,150. So that's a 15% increase. And I'm just going to spitball here and say I think it'll be making $1,500 for me, my $25,000 investment in 5 years. We can look at the margin. We can make comments, outstanding, except the metaverse black eye that is now reversed. You see what I'm saying? You could talk about, this investment memo is meant to do is it's meant to take you through step by step the process of thinking through an investment wisely. So you and look like a business, just like Warren Buffett talks about. You're not buying a stock, you're buying a business. And so this will help to stable you and your decision making, especially in times where the market gets shaken and loses its head. You won't, because you'll know why you bought this stuff. And so the stock price is going up and to the right here. Sorry, not the stock price. We don't look at stock prices here. The net income is going up and to the right. And you could think about it like this too. If you're buying something at parity, the same valuation, 25 times price to earnings as the market, and if your investment grows at twice the market, then the market may lose its head for a while in terms of valuation, but at some point it's going to not lose its head. If this thing grows twice as fast as the market, then at some point it's going to be trading at a far, far lower discount than the market if they stay at price parity with one another, but they're not gonna. Eventually, this will win out, and this is just a way to think about it. So anyway, net income, you can look at operating margin, you can make your comments, dividend analysis, you can do the same thing, payout ratio, revenue analysis, their compound annual growth rate for revenue, net income, cash, free cash flow, all these things, and shares outstanding. You can do the balance sheet cash analysis, same thing, long-term debt, the cash flow from operations analysis, free cash flow, the price to earnings, you can talk about what it's at. It's currently at 23. Well, it's currently at 24.9. I need to add the TTM period and the today period, but I'll do that later. Then you would talk about what is the company's competitive advantage. You would capture what you think it is here. What are the key non-financial metrics? Like if another social media company comes along, you'd put that here. Your final investment decision, what would have to happen for your investment thesis to be correct? And what would have to happen for your investment thesis to be wrong? What is your anticipated hold period, short, medium, long, and I define these. Your investment decision, buy, hold, sell, just watching, or it's too hard for me to know. Your level of conviction, I think this is important. You got your lowest, like an intern we found on Craigslist, just hoping it doesn't steal my wallet, all the way up to either this thing works or someday I'll be an 80-year-old Walmart greeter. These are like, what is your real gut check? This is a gut check. Like, what is your real level of conviction? Are you just buying on the hype? Are you buying on the hope number go higher kind of thing? Or are you really knowledgeable about this where you can feel confident? Most of mine are in this range, but with Meta and one other, they are right here. Same with Google. And same with one other one I can tell about at a later time. And then your conclusion, you'd put it here. So what you'd do is you'd click Save Memo, and then you'd get this really cool message that we won't even care about right now. And you can go and you could look at your investment memo, and other people can see it too, as long as you marked it as public. It's public by default. So I'm going to look and show you my own Meta investment memo that I put up at an earlier time. Let me just click on it here. Why is it not showing? Here we go. Okay, so on April 28th, I titled my investment memo Expansion Update, because I call all of these things business lines in my small business stock market startup. I'm now in the business of selling your attention and Meta. And then I talk about how my stock market startup, Uncle Brad Inc., has acquired a social media company. And I talk about why, the math, the business model, the balance sheet, the track record. And this is a very important one. I feel more conviction about this business than any other, and it's not even close. Then I compare it to the S&P 500. At the time I was doing this, I could have bought $84 of net income for what I spent on this. I don't remember what I've spent. I have it down here. $2,311 is what I spent on this. And I could have bought $84 worth of income from a business that makes basically everything in the U.S., has grown its earnings by 8.7% per year over the last 10 years, has grown its revenue by 6.8% over the same period, and carries about $240 of long-term debt. Or, option B, I could buy $105 in net income as opposed to $84 in the other business. Utterly dominates its market, selling the attention of literally half the people on earth, grows earnings by 34% a year, revenue by 26% a year, has no long-term debt. And I say it would be straight up stupid for me, and I believe this, to pay more money for less profit, especially considering each option's future prospects for growth. Option 1 was S&P 500. Option 2, Meta. Now, obviously, these are at parity right now. They were not when I bought. Meta was trading at a substantial discount. And so then you can see what I said. Like, it's a buy, my highest level of conviction. I went through and I talked about what I thought its competitive advantage was, what I thought its one-year estimate would be, key non-financial metrics, my analyst notes on net income, and didn't put any in operating margin, my analyst notes on dividends. These are just thoughts that I have that I can go back and I can check myself later and start to hone my investment strategy and sharpen it by looking at whether I was good or bad in these things, and whether I was and how I need to adjust based upon how reality actually played out. And then I can see all this stuff. And then there's a conclusion. Then I've even updated it after first quarter revenue came or earnings came out. So this is how you can use your share to make your share in the markets more profitable. There's also a portfolio tab, which I haven't gotten to yet. I'm still working on it, but it is going to be awesome when it's done.